Okay, so let's talk about life insurance. Okay, so what is life insurance? So an insurance company, in other words, agrees to pay the designated beneficiary of the insurance policy an agreed upon sum upon the death of the policy holder. So let's break this down a little bit. Let's talk about what this is saying in regular terms. So who is the policy holder? So this is going to be you. So let's say you are a young parent and you want to protect your family in the case that you die by receiving, some kind of financial payment. So if you die, your family will get some money to, hopefully provide them with some financial security since you're no longer there, you're no longer earning, and so a way to do this is by purchasing life insurance. So you are the policyholder, you would buy this life insurance policy and you would designate who is to benefit from the life insurance payment upon you dying. So if you died, who is going to get the payment that the policy is basically going to be covering? So let's say you got a $200,000 life insurance policy. Who is that $200,000 going to go to if you die? And so that is the beneficiary. So this could be your wife or your husband. This could be your kids. So you would buy insurance basically to cover your beneficiary financially through whatever the size of the policy you're getting. So you can get a 200,000, 100,000, 500,000, $1 million, $2 million. So the more coverage you get for life insurance, the premium that you're going to pay is going to be more. Um, but there's different levels of this insurance, and as long as you pay the premium, and you don't, there's certain types, like suicide. You couldn't just commit suicide and have your beneficiary receive the payment. So it has to be like an actual covered cause of death. And but if that happened, an accident or whatever, your beneficiary would receive the life insurance payment. So life insurance, I kind of gave you a very simplified version of what would happen, but the types of coverage you can get are very diverse and could be simple, but can also be very complex. And I'm not going to go through all the details because, for one, I'm not a total expert in life insurance and all the nuances of it, but I will kind of cover some of the high level concepts in life insurance. And if this is something that you think is something you'd like to get, if, again, if you're like a young parent or if you're older and you kind of want to leave something behind for your heirs, you can, I recommend you basically seek out a life insurance agent who is more familiar with all the different options. But just for your information, let's talk about a couple of high level things. So there are two different types of coverage in general. So one is term life insurance. So basically, it only lasts for a certain number of years. So this is the term, after which the policyholder would be uncovered. So typically, this is going to be for younger people, and you'll get this kind of insurance in case you die unexpectedly. So basically, let's say you're 25, you have a young family, you're young yourself, and your chances of dying are pretty low, like for the next, like, let's say 30 years. But you just want to make sure that your family would be covered in the case that something did happen. You could get a 30-year term life insurance policy, and that would basically cover your death if something happened for those 30 years. But once you went from 25 to 55, after 55, this insurance coverage would no longer apply. So it's basically you're getting it to cover the rare, unexpected death and kind of make sure that your family or your whoever is your beneficiary is taken care of. And so this is much cheaper because, again, the chances of this happening, especially if you're younger, are much lower than permanent life insurance. So permanent life insurance covers the insured for their entire remaining life. Whole life insurance is the simplest form, which just provides lifetime coverage for a set premium. Universal life insurance is another type of permanent insurance, but it's more complicated than whole life. It has different payment schemes. and different kind of payouts depending on how you structure your payment of the premium over time. So these are typically, especially if you get them when you're older, are going to be more expensive because they will cover you, until you die. If you start with a whole life insurance earlier in your life and you continue with it, it will be cheaper because you end up paying more into the insurance policy, and so the insurance company can actually uh, make money off of it if you're paying into it for a longer period of time, so that they adjust the premium accordingly. So this is more of like wanting to leave something behind when you die for your heirs. So the more complicated life insurance plans have something called cash value, and it's basically an early redemption right. So in some ways, life insurance is like a savings account, especially permanent life insurance, because you basically are paying into this policy every year, and it's accruing kind of a value. And of course, if you die earlier, the return on your invested premium, you can say, is higher because the payment comes sooner. But the way the insurance company prices this stuff is based on these actuarial tables that say on average how, like, if you're 30 and you're in good health, then on average, if you had many 30-year-olds in the pool of insurance, they're typically gonna last for 40 years. Some may die sooner, some may die later. So they use these tables, and since they're insuring so many people, they can use the statistics across a large number of people to kind of charge an average premium for the entire pool. And so it's kind of a way of sharing risk. But anyways, back to the cash value thing. So you're essentially kind of paying a premium every year into this policy, and let's say you wanted to end sooner, like you didn't want it to cover you till you died. A lot of policies have a cash value, meaning you could just receive a lump sum back and kind of end the policy. And so, if you're interested and you kind of aren't great at saving well, an insurance policy could be something that you could look into, because you don't have to have the policy necessarily until you die. You could take out the cash value, but again, I recommend you deep dive into this. I'm just providing you with this kind of high level, like just knowing that such a thing exists. And I think if you really want to explore the ins and outs, you got to spend it could be a whole course just on life insurance. Um, but it's worth knowing that cash value and these types of insurance policies exist. Okay, so now let's talk about workers' compensation, also called workers' comp. So basically, this is a coverage provided by employers that will cover your wage replacement and medical coverage for any injuries that occur during the course of employment. So while you're on the job, if you suffer any injuries, your employer will have workers' comp coverage. And so that will uh, cover any medical expenses that are related to the injury. And if you can't work, the workers' comp will also provide you with some wage replacement. In exchange for workers' comp coverage, employees, forego the right to sue the employers for negligence. So this is kind of a bargain that was reached between labor and employee, labor and ownership, just through the course of kind of labor relations in America, where the employee will benefit from this coverage, but then they can't also sue their employer for negligence unless I'm sure that if it was truly negligent in the sense that the employer wasn't up to the standards that are set, and there was something truly messed up about the situation. um, your legal recourse to your employer is very limited because you're covered under this policy for workplace injury. So so the employer is obligated to provide a safe workplace, tools, warnings of danger, and adequate coworker assistance. So if you're lifting heavy things, then there's a certain limit to how much one person can carry, for example. So the employer has certain obligations. But you, if you are injured, cannot just sue your employer just because you're injured. You're going to be covered by this insurance. So it's typically required for employers to carry workers' comp coverage, usually in the form of insurance coverage. So they will basically pay an insurance company to do this. Though some employers will self-insure if they are large enough, meaning, they have enough financial resources. Let's say you're like a national construction company. You may not pay an insurance company to do it. You may just, since you're large enough, just cover any of these claims on your own through your own financial resources. And claims are handled by an administrative law judge rather than in courts of law if there's a dispute. So you cannot have recourse to a court of law where there's like, criminal or more severe financial penalties. Workers' comp claims are happening in these administrative courts with administrative law judges.